It starts while you're asleep. No headlines, no market open bell, no breaking news banner. Just trillions of dollars moving in the dark. By the time you check your phone in the morning, the most important financial transaction of the day has already happened. Not in the stock market, not in crypto, not in housing, in cash. Or more precisely, in the price of borrowing cash for one night. Roughly $2 trillion changes hands every business day in a market most people never hear about. It doesn't trend on social media. It doesn't produce celebrity CEOs. It doesn't create viral screenshots of 300% gains. But it quietly decides what everything costs. Your mortgage rate, your car loan, your business line of credit, the valuation of tech stocks, the survival odds of startups. All of it leans on this one question. What did money cost last night? Here's the uncomfortable truth. Money itself has a price. We talk about prices of houses, prices of stocks, prices of groceries, but we rarely talk about the price of money. And when that price moves, it pulls the entire economy with it. Right now, that price is under pressure. Governments are borrowing heavily. Banks are navigating tighter rules. Investors are hunting for safe returns. Central banks are trying to fight inflation without breaking the system. All of that tension funnels into one place, the overnight funding market. Let's simplify the scene. At the end of each day, some institutions are sitting on piles of extra cash. Maybe they collected deposits. Maybe they sold assets. Maybe clients wired in funds that haven't been redeployed yet. Cash sitting idle is wasted potential, so they look to lend it just until tomorrow morning. On the other side are institutions that need temporary cash. Maybe they bought government bonds and need to settle the trade. Maybe they're managing daily liquidity needs. Maybe they're bridging a short-term gap. They don't need money for 30 years. They need it until sunrise, so they borrow for one night. The lender earns a small amount of interest. The borrower gets the liquidity they need. Tomorrow, the transaction reverses. Simple. But that small interest rate, quoted annually, becomes the foundation of the entire financial system. Because if you can safely earn 5% lending money overnight, why would you lend it for 10 years at 4%? You wouldn't. So longer-term interest rates adjust upward. Mortgage rates climb. Corporate borrowing costs increase. Asset valuations shift. One night sets the baseline. Think of the global economy like a massive skyscraper. Stocks are the glass exterior. Real estate is the structure. Corporate bonds are the internal wiring. The overnight funding market is the foundation slab. You don't see it, you don't admire it, but if it cracks, everything above it trembles. This isn't theoretical. In 2008, trust between financial institutions evaporated. Banks became afraid to lend, even for one night. Overnight rates spiked unpredictably. Liquidity dried up. It wasn't just a credit problem. It was a confidence problem. When institutions refuse to lend overnight, they're essentially saying, I'm not sure you'll still be standing tomorrow. That fear spread through the system faster than any official policy could contain it. Central banks learned something critical from that moment. Control the overnight rate or risk losing control of everything else. So today, central banks don't just observe this market. They target it. They set a range for short-term rates and inject or drain liquidity to keep overnight borrowing within that corridor. But here's where it gets interesting. They guide it. They influence it. They don't fully command it, because the actual price of money each night is determined by supply and demand. How much cash is available? How much is needed? How much high-quality collateral exists to secure these loans? And this is where the story becomes more complicated. Most overnight borrowing isn't unsecured. It's done through something called a repurchase agreement, commonly known as repo. In a repo transaction, one party sells a government bond, usually a Treasury, to another party and agrees to buy it back the next day at a slightly higher price. That small difference is the interest. Technically, it's a sale and repurchase. Economically, it's a secured overnight loan. Cash flows one way, Treasuries flow the other. Tomorrow, everything reverses. This structure makes the system appear safer. The lender holds provides high-quality collateral. If the borrower fails, the lender keeps the bond. Clean, efficient, logical. But now think about what that implies. The smooth functioning of this market depends on two things: confidence in counterparties, confidence in the collateral, mainly government debt. If treasuries are trusted, liquidity flows easily. If something shakes confidence, political gridlock over debt ceilings, sudden surges in government borrowing, extreme volatility in bond markets, this plumbing tightens. And because governments are running large deficits, the supply of short-term debt has exploded in recent years. More bonds, more collateral, more need for financing. That changes the balance of supply and demand in overnight markets. When there's too much cash chasing safe assets, overnight rates fall. When there's too much collateral and not enough willing lenders, rates rise. Small imbalances can produce sharp moves. In 2019, with no recession and no banking panic, overnight repo rates suddenly spiked from around 2% to nearly 10% within days. Nothing dramatic happened on the surface, but underneath, liquidity was tighter than expected. Corporate tax payments and Treasury settlements drained reserves. Banks hesitated to expand balance sheets. Demand for cash surged. The plumbing strained. The Federal Reserve had to step in and inject tens of billions of dollars to calm the market. It was a quiet reminder. This system runs on precision. There isn't a huge margin for error. And today, the stakes are even higher. Governments carry record debt loads. Investors can earn meaningful returns on cash for the first time in years. Banks face stricter capital requirements. Global demand for U.S. dollars remains enormous. All of these forces converge nightly. $2 trillion, repriced every 24 hours. This is the heartbeat of modern finance. When it beats steadily, credit flows smoothly. When it accelerates or skips, volatility follows. And most people never notice. They focus on stock charts. They debate inflation headlines. They react to earnings reports. But the real question is quieter. What did liquidity cost last night? Because that number doesn't just influence markets. It quietly decides who can afford to borrow, who can afford to grow, who survives when conditions tighten. And once you start watching the price of money instead of the price of stocks, the entire financial system looks different. This is just the surface. In the next part, we're going to step deeper inside this $2 trillion machine, who the biggest players are, why global dollar demand flows through it, and how small shifts in this market ripple into housing, tech valuations, and even government budgets. Because once you see the mechanism clearly, you won't be able to ignore it again. Now, let's step fully inside this machine. Because $2 trillion sounds dramatic, but who is actually moving that money? And why does it have to move every single day? Picture the end of a normal business afternoon. A large commercial bank has taken in deposits, corporations parked cash, clients sold assets. By closing time, that bank might be sitting on tens of billions in excess reserves. Idle cash earns almost nothing. That's inefficient. So the bank looks for a safe, short-term return. Across the system, a money market fund is in the opposite position. It manages cash for corporations, institutions, maybe even parts of your retirement account. It promises liquidity, stability, daily access, but it still needs to invest that cash somewhere extremely safe. Enter the overnight funding market. On one side, cash. On the other, high-quality collateral, usually U.S. Treasury securities. They meet in the middle through repo. Here's the mechanical reality. A hedge fund, for example, may own a large portfolio of treasury bonds, but instead of holding them passively, it finances them. It temporarily sells those bonds in exchange for cash and agrees to buy them back the next day. Why? Because leverage. By borrowing against those bonds, the fund can hold more positions than it could with cash alone. The overnight market becomes its fuel source. Now multiply that behavior across thousands of institutions, banks managing liquidity, money market funds seeking safe yield, broker-dealers financing inventories, hedge funds running leverage strategies, government-sponsored entities parking cash. This isn't a niche corner of finance, it's the circulatory system. And like any circulatory system, it depends on flow. When flow is smooth, nobody talks about it. When flow tightens, everything feels it. There's another layer here most people miss. This market doesn't just balance domestic banks, it also absorbs global dollar demand. The US dollar is the world's operating currency. International trade, commodities, sovereign debt, much of it is priced in dollars. A European bank that needs dollars to settle trades might tap short-term funding markets. An Asian corporation with dollar-denominated debt needs access to liquidity to roll it over. When global stress rises, demand for dollars spikes. And where does that pressure show up first? In short-term funding markets. Overnight rates begin to creep higher. Suddenly, what looked like a calm domestic plumbing system becomes a global pressure valve. That's why central banks coordinate dollar swap lines during crises. They're not being generous, they're protecting liquidity, because if dollar funding seizes, global finance strains within hours. Now let's talk about something subtle but powerful, the risk-free rate. In finance, every investment is priced relative to a baseline. That baseline is what you can earn with minimal risk. Overnight lending secured by government bonds sits very close to that foundation. If you can earn 5% lending overnight with high-quality collateral, that becomes the hurdle. To justify buying a corporate bond, you'll demand more than 5%. To justify investing in a startup, you'll demand far more. To justify buying a 30-year bond, you'll compare it to rolling overnight loans again and again. This is where valuation math quietly shifts. When overnight rates were near zero, almost any future cash flow looked attractive. Investors discounted future earnings at extremely low rates. Asset prices inflated. Tech companies with profits decades away commanded massive valuations. Housing prices soared. Private equity deals stacked leverage cheaply because money was almost free. But when the overnight rate climbs meaningfully, that math flips. Future cash flows get discounted more aggressively. Borrowing costs rise. Leverage becomes expensive. Margins shrink. Nothing about a company's product changes overnight, but its valuation can. All because the baseline price of money reset. Now, let's revisit 2019 for a moment. There was no global panic, no dramatic collapse, yet repo rates suddenly spiked close to 10%. Why? Liquidity wasn't where the system expected it to be. Corporate tax payments pulled cash out of banks. The U.S. Treasury settled large bond auctions, draining reserves. Regulatory constraints made banks reluctant to expand balance sheets at quarter end. The system didn't break, but it stretched. And stretching reveals fragility. The Federal Reserve stepped in quickly, injecting liquidity and stabilizing rates. Here's the uncomfortable truth most people never see. A small change in overnight rates doesn't stay small. It ripples, expands, amplifies. When overnight funding becomes more expensive, everything downstream adjusts. Governments roll over trillions in short-term debt. Higher overnight rates mean higher interest payments. Higher interest payments mean larger deficits. Larger deficits force either tax increases, spending cuts, or more borrowing. Corporations refinance bonds at higher yields. Home buyers lock in mortgages at steeper rates. Private equity and hedge funds face rising leverage costs. The cost of running the system itself climbs, and because modern economies are deeply leveraged, governments, corporations, households, all three exposed to debt, the sensitivity to these small overnight shifts is enormous. This is where power quietly concentrates. Institutions with access to cheap funding survive and grow. Those dependent on rolling short-term debt feel the squeeze first. Liquidity becomes a competitive advantage. Cheap money fuels risk-taking. High liquidity costs curb it. When the cost of borrowing rises, asset prices fall, risk appetite declines, speculative excesses vanish, margins tighten, efficiency matters. It's subtle, it's quiet, but it reshapes the rules of wealth. Now consider the common narrative. Headlines suggest central banks decide rates. Analysts watch press conferences, adjust forecasts. Markets react. But the real enforcement happens nightly. Does cash flow smoothly? Is collateral sufficient? Are institutions confident lending to each other? If confidence falters, the overnight plumbing can seize. Policy intention versus market reality becomes stark. Rates can behave unpredictably. Liquidity doesn't follow a memo. Zoom out. The global economy is interconnected. Cross-border flows, sovereign issuance, regulation, geopolitical events all feed into liquidity. A dollar shortage in one region, a funding squeeze in another, suddenly impacts everyone. Overnight funding is not just domestic, it is global. The US dollar is the backbone of trade, debt, and corporate finance worldwide. $2 trillion flows every night, priced, rebalanced, assessed. The system resets daily. Now imagine sustained higher overnight rates over months or years. The era of ultra-cheap leverage may be over. Assets, once inflated by near-zero funding costs, look less attractive. Startups face real borrowing costs. Corporate strategies adjust. Government spending faces harder choices. Change is gradual but persistent. No single crisis, no dramatic collapse, just a quiet, structural shift. And that is the real power of this market. It doesn't just influence prices, it subtly redistributes financial strength. It rewrites who survives, who grows, and who falls behind. The ripple touches housing, corporate borrowing, global trade, even political priorities, and all of it begins in the quiet of one night. $2 trillion moves again tonight, repriced, rebalanced, reassessed. No headlines, no applause, no attention, but everything you see tomorrow, the rates, the valuations, the investment flows, traces back to that price of liquidity. So here's the lingering question. What happens if one night of money never becomes cheap again? If liquidity permanently commands a higher price, the rules of borrowing, growth, and wealth distribution could shift forever. And that shift, silent, invisible, nightly, is already underway. The system will continue to turn, but every rotation will be more expensive, and the cost of a single night of money may quietly rewrite the global economy without anyone noticing until it's too late.